So what I want you to do is, I want you to record the journal. We do it quickly. Okay, we spend maybe like 15 minutes on this exercise. So the start is so first is owner's capital. So now I want you to write the journal manually in your papers. So how will you record the journal when the owner invests the money? Let's say owner invests the money in cash.
So
What is coming in?
debit,
No, what is coming in?
cash,
Cash is coming in, right? So what will happen to the transaction? Cash will be debited. So you write down the first leg is cash debit. Assume any number you want, maybe 1,000, 2,000, 5,000, whatever. And what will be the credit? Remember the rule, fourth rule, credit the liabilities. For business, owner's equity is a liability towards the owner, right? So because nothing is going out, actually only cash is coming in, nothing is going out, right? So you cannot apply the rule 1 or 2. It's not an expense or income, so you cannot apply that one also. You will have to apply the fourth rule where say credit the liabilities. So this is a liability, right? Owner's equity is a liability towards to the business. So credit owner's equity. Owner's equity will be credit for whatever amount you want. Okay. Then you are creating a liability, means creating a debt. So it's same like taking a loan. So second transaction is take a loan. Maybe whatever amount you like, 1 million, 10 million, 1 billion. Just do your imagination. So let's say you take a bank from AIA bank loan. So now you record bank loan. So what will come in?
cash,
Again cash will come in, right? So say cash debit, whatever amount you want. Credit will be AIA bank because you take loan from the AIA bank, right? So you have a liability towards AIA bank. So that will become credit. So whatever amount you want to write. So now you use this two money, right? You accumulate, I don't know how much money you accumulate. Whatever is your imagination. Then you need to buy an asset. So let's say you are buying a building from this asset. So now you make an entry for buying a building. So what is coming in?
asset,
Asset is coming in, building is coming in, right? You get a right to use the building, and what goes out?
cash,
Cash goes out. So what will be the accounting entry? Building will be debit,
debit, cash,
cash will be credit. So make it entry. But don't make more than your capital. Whatever you buy, whatever you initially invest and you take the loan, you can spend lower than that. Don't spend more because you don't have money, right? Then the third one is owners withdraw the business fund. Now owners say, oh, you have got a loan, right? So I can use the money for my own personal adventure. So they borrow, they bring the money out from the business. So you can assume whatever you are maybe going to Disneyland or going to the anywhere, maybe 1,000 or 100. So you withdraw money. So what is happening now? What is going out?
cash,
Cash going out. And what is coming in? Nothing. So what is happening now then? It's not an expense also because it's not the company's expense, right? The owners withdraw its liability. So what happens is his liability reduced, correct? If owner's equity was 100,000 and he withdraw 5,000, so how much you need to pay him now? 95, right? So his liability reduced. So the rule 4 says debit either asset or reducing the liabilities. If you are reducing the liability, it need to be debited. So owner's account will be debited. Or you can follow the rule number 3 where it says debit the receiver. Debit the receiver. So who is the receiver of that cash? Owner, right? So owner account will be debited, credit will be cash. So owner's account is reduced by 5,000 and cash also reduced by 5,000. Then you have income received. So maybe you can do any business. You are doing a sale of anything, consulting or whatever, rent or from the building that you own. So now you are receiving an income. So you can receive a cash and record the income. Okay. income on credit. Now you are still getting an income but on credit. You're not getting the money. So means you are recording some or receivable, right? Receivable is your asset, or you can say who is receiving the income, who is receiving the services is your receiver. So debit the receiver, correct? So the person who is your customer will be debited, credit will be income. Then you have getting paid. So since you sell on credit, you need your money back, right? So you get your money back. So what will happen in this case? What do you get? You get cash, and what is credit then? Receiver, because he is the giver, right? So he is giving the money, the debtor is giving the money, so you can credit the receiver. Then you have an expense paid, or expense paid on credit will be simple, right? Buying an inventory will also be simple, because inventory will be debited, and what will be the credit? Buying an inventory means is cash, correct? Use inventory to sell, because you use the inventory. So inventory means you buy a pen. So you buy 10 pens and record as inventory. Now 2 of them are taken by the business